Hi, Maria.
Hi,
Hey, welcome back to class.
thank you.
Who do you like in the Super Bowl, Maria?
I don't know who's in the Super Bowl. I'm not a big football person, so
I'm teasing you a little bit. The Philadelphia Eagles and the Kansas City Chiefs.
okay. Um, I'll go with the Eagles.
Yeah, they're a slight favorite to win. They're a slight favorite. They've been the best team in the league all year. Them in Kansas City.
Perfect.
Pray tell, who do we have here coming in now? Hi, Brendan.
Hi, how are you?
Good to have you back.
Wait.
Okay, we'll wait maybe just a few more seconds and we'll get into chapter five. I hope you find chapter five a little bit interesting. When you go through chapter five, you're going through the type of work that I did for many, many, many years. Inventory type accounting, working in a manufacturing business where you're making a product and doing the lower of cost of market calculations all the time. So let's see if we can get going, okay? All right. We are now, let me set this up the way I like it. That's the way I like it. Okay. Chapter five, inventory, cost of sales. Inventory and cost of sales, also called cost of goods sold. Cost of sales or cost of goods sold is what you paid for the product that you sold. Okay, you sold a garment for $1,000. That's your sale. You purchased that garment for $300. That's your cost of goods sold, an expense. So we're going to talk about some inventory methods and a couple of other things. So let's what we have here. Identify the items making up merchandise inventory. Merchandise inventory includes all goods that a company owns for sale, regardless of where they're located when the inventory is counted. And what they're
Uh,
getting,
are
yeah.
you supposed to be sharing like your screen? Sorry.
Thank you, Brandon.
No worries.
Jeepers creepers, what's wrong with me? Can you see? Can
What was that?
you see it
Hi.
now?
Yeah. Perfect.
Okay, sorry about that. Lapsing into some bad habits here, huh? Jesus. Okay. Identify the items that make up your merchandise inventory. This chapter is on inventory and cost of sales. Cost of sales, what you paid for the goods that you purchased. Identify the items that make up your inventory, huh? Inventory includes all the goods that a company owns and holds for sale, regardless of where they're located when it's counted. And what we have here are issues with goods in transit, goods on consignment, or damaged or obsolete goods. I'll talk briefly about each one. Goods in transit mean product that's on its way to a customer or a product that's incoming to your business. It depends on the FOB terms. We talked a little bit about FOB, I believe, in chapter four. FOB I'm sorry, FOB means freight on board. FOB destination means that the title changes only when the goods arrive at the buyer's location. If it was FOB shipping point, as soon as that truck left California from my Newark, New Jersey factory, I am responsible. I own those goods. So goods in transit, FOB, uh, represents the point in time where title changes to the goods. Okay. Goods damaged or obsolete. Let's talk about that a little bit. You're counting your inventory and you find out you have five damaged pieces of inventory. They don't work for some reason, they don't test out properly, or you can see physical damage. You have to take the loss immediately. You are not going to count that in your inventory, but you're going to record the inventory reduction and the commensurate charge to cost of goods sold. You're going to debit cost of goods sold dash obsolescence perhaps, and credit inventory. And on our course here, we're mostly talking about merchandise inventory. Goods on consignment. Let's understand that. Goods on consignment. You know how you walk into Macy's on the main floor and you are sort of overwhelmed by the smell of perfumes, and you see these ladies behind the glass kiosks schlepping the product? Those perfumes don't belong to Macy's. They belong to Lanvin. They belong to L'Oreal. They belong to the perfume company, and they are shipped what's called on consignment. What this means is Macy's does not own those goods, but Macy's will try to sell them. Macy's will sell them for, say, $100 per jug, and then they'll turn around to us and say, we sold one of your products for $100. Give me $50. So consigned goods is a way to move goods around the country, but you just got to keep track of them. So goods on consignment, they have to be counted in your inventory, not in Macy's inventory, our inventory. And here we're talking a little more about goods in transit. FOB shipping point, goods included in the buyer's inventory when it's shipped. Why is it included in the buyer's inventory? Because title changed hands as soon as that truck left our business here in Santa Barbara. If the terms were FOB destination, the buyer owns those goods until they arrive at the destination. Believe it or not, these can be contentious between businesses. Some businesses will say everything that comes to my place is FOB destination. I don't want to have to deal with paying the freight charges. I don't want to worry if it goes off the rails somewhere. I want the seller to be fully responsible for those goods until they reach my place. FOB shipping point is the opposite. FOB shipping point. You're shipping to me in New Jersey. The truck leaves our little plant here on campus, turns right on Cliff Drive, and then tips over, and all the goods are damaged. I am responsible for it because the title changed hands at the shipping point, okay? The FOB point is just when title changes hands. And these can have a strategic effect too. For example, I once worked briefly, before I retired, worked briefly for this company that had terrible cash flow. And sometimes it was difficult even to get up the money for the payroll, if you can imagine that. So what I was able to do was tell our supplier in Oklahoma to put a rail car of resin on the railroad tracks and then close the seal. That meant that it was FOB shipping point, and I own this. Now, why am I telling you this? Because those goods were roughly $150,000 per freight car. I had a deal with the bank where I could borrow 75% against the inventory. So as soon as we had that inventory on its way to us, we owned it, and I could borrow money to pay people. Not a great way to do business long term, but these in transit terms can be helpful. Here we go, talking a little bit about goods on consignment. The consignor, they're the people who own the goods. Fabergé perfume is the consignor. The consignee is Macy's. Macy's is going to sell that product for whatever price they can get. And every time Macy's sells one, they're going to pay us what we would have charged them. Hopefully Macy's sells it for $200, and then they charge, and then we charge Macy's maybe $60, whatever the normal cost is at that level. And the merchandise is included in the consignor. The consignee never reports the goods in their inventory. And this can be pretty important when you're taking a physical count, to remember to scoop up all of this material that's not necessarily in your building at any particular time. Damaged goods, not reported in the inventory if you can't sell them. Nope. You have to, which only damaged or obsolete gold, let me say it this way, damaged or obsolete goods that you can't sell. you must take a hit immediately. You must debit cost of goods sold and credit merchandise inventory. And at that point, you've taken the loss for those goods and you can throw them away. Okay. Damaged or obsolete goods, which can be sold, are included in the inventory, but at what we're going to call net realizable value. You bought inventory for $100 per item. And now your sales force is coming back to you and saying, this item we bought is out of style. Very few people are buying them. No one's going to give us $100. We'll be lucky to get 80. At that point, you have to recognize the loss since the market price is now lower than what you paid for it. And you have to take that same journal entry, debit cost of goods sold, credit inventory. What's net realizable cost? Sales price minus selling costs, huh? Net realizable value, sales price minus selling costs. The loss is recorded when you find out about the or the obsolescence. A forklift driver knocks over a pallet of goods and it all breaks, it's all glass. That's a loss to be recognized immediately. You can no longer pretend you have those goods for sale. Identify the costs of the merchandise inventory. In the earlier objective just now, we talked about the where and when a little bit. Identify the cost. All expenditures necessary to bring an item to a sellable condition and location. Include all those costs. For example, you bought a rail car full of chemicals back in New Jersey, and the goods are on the way to you. Don't you think that's a pretty big freight bill? Somebody has to pay the freight. If you're paying that freight, that's part of your inventory cost, shipping cost, storage. Maybe it's the type of product where it has to settle in for a couple of weeks before you can try to sell it. Any costs involved there in testing it? Maybe you have a lab that's going to look at it. You're going to have insurance on it for sure. That insurance for bringing it across the country becomes part of your inventory cost. And if you're importing it, you're going to find a lot of duties there, a lot of taxes, all become part of the inventory cost. A little bit on internal controls about taking a physical inventory. Most companies take a physical count at least once a year. Once a year. If you have a periodic system, you have to take it once a year or once a month if you're going to try to prepare financial statements. The perpetual system, you may not have to take a physical inventory every year, but most companies, I'm going to say, do it anyway. It's an important control. When the physical count does not match the merchandise inventory count, an adjustment must be made. So we went out and we counted this part number A, and our perpetual records say we have 100 units at $5 each, $500. We go out there and we count, and we don't have 500. We've only got 400. Well, we might double check. We might try to find out why we have this discrepancy. But at the end of the day, all we know is we lost 100 of these units. We're now going to take $100 and write that off. We're going to debit cost of goods sold, dash inventory shrinkage perhaps, and credit merchandise inventory. And these are some controls when you're counting inventory. Pre-numbered inventory tickets. Counters have no inventory responsibility. That's a tough one to get around. What they're saying there, it's better to have people who are perhaps not that familiar with what they're counting, believe it or not, because the counters might be in a position to pull a few fast ones, move inventory around, cover up a mistake or something. So the counters have no real responsibility for inventory. They confirm the existence and the condition and the amount, of course, of what's out there. And then typically you would have a second count taken by a different counter. And that would probably wrap things up. You then run a bunch of reports that list all the things per your perpetual and compare it to what you actually counted. Any difference is a write-off. and the manager confirms all items counted only once. Here we go. Now, I hope you have a little fun with this chapter. I used to like to do these inventory costing methods. We're going to talk about 4 methods. There are others, but we're going to talk about 4 of them. These methods are used to take the cost of goods available and assign those costs to either the inventory or the cost of goods sold. We've got specific identification, where we know exactly what item went out, when, and where it is. First in, first out, where we assume we are selling the oldest item first. Last in, first out, we're pretending we're selling the most recent item first, and then weighted average, which is just what it says, an average costing. And if you look at the pie chart here, almost half the world uses FIFO. Half the world uses FIFO because that's usually the way it works in real life, huh? You're always trying to sell the stuff that came in last week as opposed to today. A lot of companies use LIFO, and we're going to learn why. And then you have weighted average, and then other methods such as first in, first out, not first in, first out, but some of the life's digits. And there's a few other weird methods. Okay, let's take a look here. First in, first out. The costs flow in the order incurred, okay? So you had a beginning, it looks like on May 1st. We'll call that a beginning inventory, May 1st, $45. Then we brought in 65 more, and we brought in 70 more, okay? We had a sale then. We sold $45 worth of stuff. We are assuming that the $45 came out of the first level, okay? On the first in, first out, we're always starting with the most recent receipt of goods, and that becomes the first, the oldest one goes out first, okay? Let me clear that up. That was a little clunky. First in, first out, old goes out immediately in our calculation. So what was the first item here? The $45 they had on May 1st. They sold $45. We pretend that it came out of the 45. We don't know that. I mean, we might have picked a couple out of here, a couple out of here. All we know is we sold $45, and under first in, first out, we're going to start at the oldest item first. So the $45 goes into the cost of goods sold. The balance, the 65 and the 70, that's 135 in the inventory. Let's take a look at last in, first out. Last in. Here, we're assuming we sold $70, but it's under last in, first out. So which ones did we sell? We sold the most recent receipt, May 6th. That's the newest stuff. So last in, first out, notice that the cost of goods sold is now 70 compared to 40 for first in, first out. So companies go to a lot of trouble to decide what method to use, and we'll talk a little bit about that. And then we have the weighted average. All you're going to do with the weighted average is thank me for putting it on the test. It's the easiest one. You'd simply add your 3 layers and divide by the mean. 70 plus 65 is 135, plus 45 is 180, divided by 3 gives you $60, okay? So that's a brief intro to the inventory cost flows. Now look at this chart here and tell yourself this is super important to understand. It's not terribly hard, but until we get this in our heads, will be a bit of a learning curve. Hold on one second. Oh, that's good booze. Okay. Beginning inventory plus purchases equals something we call merchandise available for sale. Okay. At the beginning of the month, we had some inventory. We purchased more inventory during the month. And at the end of the month, we're going to add those two numbers together and get something we're going to call merchandise available for sale. You can't sell any more than that, right? Whatever you had in the beginning. Let's say it's a bookstore. You had 1,500 books in the beginning inventory, and then you purchased another 1,000 books during the month. Well, that means that your available for sale number in units would be 2,500 books. You couldn't possibly sell more than you had. So at the end of the month, our job is to take that merchandise available for sale and assign the cost either to cost of goods sold or the ending inventory. The merchandise available for sale at the end of the month, it's either been sold or we still have it. Well, we went out, we counted the inventory, and we knew we had 2,000 books left. So those 2,000 books times whatever the price of the book is would go into our ending inventory, and the difference would go into the cost of goods sold. Some goes on the balance sheet, some goes on the income statement. Compute inventory in a perpetual system using these methods. Excuse me. Inventory costing on a perpetual. At the end of the month, you're going to have that inventory available for sale statistic to worry about. Inventory effects. If it's still in your inventory, it stays in the inventory on your balance sheet. If not, we have to record the cost of goods sold with a debit to cost of goods sold and perhaps a credit to the inventory. Note it says physical flow does not need to follow the cost flow. That's important to understand, and I think you do. These inventory methods are conventions that companies are allowed to take advantage of to control perhaps their tax bill or their bottom line a little bit. It has nothing to do with the physical movement of the goods. You guys know the fruit shop, maybe, I don't know if you're from out of town here, but there's a produce store near where I live up on the Mesa, and they've been there forever. They use LIFO. What that means, if you take it literally, is they still never sold the first banana that they put up on the shelf 50 years ago. Well, we know that's ridiculous, but they were allowed to pretend that in terms of their accounting. Okay. So let's see what we got here. Okay. Now they're giving us a nice look at the layering. Okay. Inventory costing illustration perpetual. Here is information about the mountain bike inventory of trekking for the month of August, okay? Here's information about the bike inventory of trekking. So they're showing you the beginning inventory. Beginning inventory, oops, let me just move something here. Beginning inventory, 10 units times 91 equals $910, okay? And they have 10 units in the inventory. They purchased 15 more 2 days later. Wow, talk about inflation. The price went up $15 in 2 days. 15 units at 106 equals $15.90. And now they have 25. And then they're selling the goods. We're not going to worry that much about the selling in terms of calculating the inventory costs. That'll come in play later. And they had purchases of 20 and another 10. So if we add this down, we had 10 plus 15 is 25, plus 20 is 45, and another 10, 55. That's what's available for sale, okay? Those are the units available for sale. At the end of the month, they can only be in one of two places. We still have them in the inventory, in which case they stay on our balance sheet, or we sold the goods, in which case they get charged off the cost of goods sold, okay? So the goods available were 55 units at $59.50, okay? It looks like they sold 43 units, huh? They sold 43, so at the end of the month, they had 12 units left. So depending on our cost system, we're going to take this available number and we're going to break it out into cost of goods sold or items still in the inventory on the balance sheet, okay? Specific ID is a simple one. It's the only method that matches the physical flow of the goods, okay? And we're usually talking, when it's specific identification, we're talking big ticket items like a vehicle, okay? If you're using specific ID, you know at all times exactly what physical item was sold. When I bought my Ford Edge about 8 years ago, I went into Perry Lincoln and I said, I'm going to buy a Ford Edge. And then I gave them my check. They didn't tell me, well, go out into the parking lot and take any Ford Edge you want. No, they have to know exactly which vehicle I bought. They need to retain that information in the event of a recall or, God forbid, an accident. So specific ID is typically for the big guys. A jeweler, believe it or not, can now track precious stones through their systems. So we had 55 units available, huh? We sold, as we know, it's saying here we sold, how many did we sell? Let me look back here real quick. Goods available, 55 units available for sale. Cost of goods sold. We sold 8 at 91. We sold 12 at 106. And then in the next layer, we sold 2 at the 91, 3 at the 106, 3 at 15 at 115, 3 at 119. In other words, when we sold these goods, we were able to go back to this slide here and say, we know exactly where these 43 units came from, okay? Specific ID is pretty easy because in the problem, they pretty much have to tell you where they got the goods. Okay, let's go to the most popular of these methods, first in, first out. Definition of perpetual. First in, first out. Well, this is the one that might come close to the physical goods, but not necessarily. Not necessarily. But we're allowed to pretend that we're selling the oldest item first. So the oldest costs end up flowing into cost of goods sold, and your more recent or higher costs end up staying in the inventory. So let's take a look here. First in, first out. We have a beginning balance of 10 times 91 equals 910. And then it looks like we purchased another 15 at 106. So now we have 10 at 91 and 15 of 106. Then we had a sale. We sold, it looks like 20 of these guys, huh? We sold 10 at 91. That's our first tranche. And then we sold 10 from the remaining 15 at 106, which leaves us with 5 units at the 106. Then we bought some more in at 106 again and 115. And then we had some sales. We sold 5, 20, that's what, 25, 35. So we go up here and we say we sold 35 of these, 5 of them from the remaining 106 up here, 20 from the 115, 10 from the 119, okay? And here's the 119 over here, okay? First in, first out, not too bad. Once you do a few of these for homework, I think it comes fairly logical. It's pretty intuitive what you're trying to do. Come on. Last in, first out. Now, this one is totally counterintuitive. We're pretending that we're selling the newest stuff first. So we're going to have a higher cost of goods sold because the prices are going up. We are assuming in this textbook that we're talking about a period of inflation. Any normal, healthy economy needs a certain amount of inflation to keep growing. Inflation has been very, very super low for the last 30, 40 years. And now we're getting into a little bit of an inflation scare where prices are maybe going up too fast. And if they go up too fast, then things can go wrong with the economy. So we're talking last in, first out, huh? Well, let's take a look. We had a beginning of 10, and then we purchased 15. And of those 15, 10 came in at 91, 15 at 106. We sold 20. We sold 20 here. Of those 20, 106 come out of there. So let's do it together here. Beginning balance was 10 at 91. Then they brought in 15 at 106, right? So we have 10 at 91, 15 at 106. Then we had a sale, cost of goods sold. We had a sale of 5 at 91. 5 at 91. And that gets us down to over here. Then we had another purchase at 115. We had another purchase where some of them were 115, 10 at 119. So the layer at the end right now is 5 at 91, 20 at 115, 10 at 119. And then at the end of the month, we figure out what we did here, okay? Cost of goods sold looks like it was 4,730 based on these transactions. Let me take it again a little bit more from the top, okay? You start off with 10 at 91, then you brought more in at 15. So now you have 25 units. Here you sold 20, 15 and 5 of the 25. That leaves you with 91 because notice that the first sale they assumed came from the most recent item, okay? That leaves us with 5. They purchased another 20. They purchased another 10. So we still have 5 from up here, 20 at 115, 10 at 119, and now the month is ended. Our cost of goods sold is 4730, and the amount in the inventory is going to be 1260. 1260. Weighted average. This is an easy one. This is one you want on the test, right? When a unit is sold, the average cost of each unit in inventory is assigned to the cost of goods sold. Or if you haven't sold it, it's going to be in the ending inventory, okay? So here is our cost of goods available number in dollars divided by the cost of goods available number in units. That's all there is to it. Here it is right here. We have a beginning inventory of 10, and then we had another 15 come in, and then we sold 20. So we add these numbers up. All we have to do here is add the cost of goods sold available number. The cost of goods sold available number, this isn't laid out as well as it should be, but the total of these items up here equal $2,500. On August 14th, 20 bikes were sold. To determine the cost of units sold, we compute the weighted average. It's just the cost of goods available divided by the units available at that time. Weighted course weighted average cost per unit. The cost of goods sold for the August 14 sale is $2,000. We divide out and we get $500 sold. Here it is, carrying on a little bit further. All we need to really worry here is that the cost of goods available, which is the total of all of your purchases plus your beginning inventory, divided by the commensurate units, gives you the weighted cost per unit average. At the end of the month, there are after the August sale, there's 5 units in the inventory. Wow, they're making the easiest method the hardest here. They're really confused. They're really throwing a lot of confusing numbers at us. Cost of goods available. All you need to do is say to yourself, the beginning inventory was 10. We purchased 15 more, 10 at 91, 15 at 106. So the units are 20. These purchases come down to 2,000. So there you go. You got $100 per unit. What I'm going to do is I'm going to put this video up for you guys to look at. And then maybe I'm going to throw another one on I did a couple of years ago where it's presented, I think, much more cleanly. This is a new book, and I don't particularly like the way they're running through the perpetual here. But it's all good. The perpetual, part 4. Oh my goodness, look at all this. The perpetual. So now we're going down to here where they're saying the cost of goods sold on the 30th is $26.22. Right here. We had 23 units at 114. Good gravy. Good gosh. Believe me, weighted average is not nearly as complicated as the book presents. Cost of goods available for sale divided by the units available for sale. That's all you need to know. And that will get you through any of those problems. Let's look at the impact on perhaps taxes and some other things, okay? Companies strategically choose these methods, right? Now, hold on here. Financial statement impacts of costing methods. First in, first out. It approximates the current cost, right? Ending inventory approximates the current cost because we're selling the old ones first. On the LIFO, the cost of goods sold approximates the current cost, not the inventory. And the weighted average method smooths them out. So let's take a look here, and this is kind of important. Financial statement effects. Because prices change, inventory methods nearly always assign different cost amounts. How about that? Let's look at specific ID. We had sales of 6,000, and we had cost of goods sold of 4,582. We sold $6,000 worth of merchandise, for which we paid 4,582, giving us a gross profit. And then we subtract the operating expenses and we get income before taxes and net income, assuming a flat rate of 30%, okay? And then they're just showing you how much is still in the inventory. Specific ID follows exactly the physical flow. FIFO. Sales again were 6,050, but now under first in, first out, our cost of goods sold was 4,570. Gross profit results 1,480 minus operating expenses gets us down to a pre-tax of 1030 minus 309, 721. Look at LIFO. The sales numbers are the same for everybody, right? We sold it for the same price. But under LIFO, our cost of goods sold is not 45.70, it's 47.30. And that brings our gross profit down from 1480 to 1320. And then we subtract operating expenses and taxes, we get to 609. So what is this telling us? It is saying that in a normal business environment of some inflation, rising prices is what I'm trying to say, FIFO will give you a higher net income. FIFO will give you a higher net income. In this case, 721. LIFO will give you the lowest net income. Why is that? Because under FIFO, when we're calculating the cost of goods sold, we're starting at the top, the beginning, when prices were lower. If we were doing LIFO, we're starting when the prices were at their highest, as prices rise all the time. And weighted average, again, the only thing you need to know about weighted average, and I would suggest you write this down or stencil it. Total dollars available for sale divided by total units available for sale. That's your weighted average, okay? Okay, tax effects on costing methods. The IRS says that when LIFO is used for tax reporting, it must also be used for financial reporting, called the LIFO conformity rule, okay? Just a little note there. IRS, if you're using LIFO for your tax reporting, you have to also use it for your financial records, for your GAAP statements. Let's introduce something that's fairly easy here and important enough to go over. Lower of cost or market. Inventory must be reported at the lower of cost or market. Lower of cost or market. What is the market price? That's basically what you can sell it for, defined as the current replacement cost, not sales price, what it would cost to replace the goods, consistent with the conservatism principle. Conservatism principle, GAAP accounting, says you always record losses as soon as you know about them. You never record a gain until you sell the product, okay? So what we have here is we're going to have to compare what our market value is compared to the cost. The lower one is what we're going to cost the inventory out. Can be applied three ways. You can do it separately to each individual item, or to major categories of assets, or to the whole inventory. We're going to work on specific items, okay? So let's see what we have here. A motorsports retailer has the following items in his inventory. He's got 20 Roadsters at $8,500 each, when the market price is $7,000, huh? $7,000. Well, let's think about that a second. He's also got a Sprint bike where the cost is $5,000 and the market is $6,000. What's our principle? Lower of cost or market, okay? We have to say to ourselves, the Roadster, 20 units, is it going to be costed at $8,500 cost, or the market, which is $7,000? What's happening here is we bought a motorcycle to sell, and we know we can't sell it for more than $7,000. We'll be lucky to get $7,000. That difference of $1,500 becomes a write-off. So we're going to take $20,000 times the lower, in this case, market, multiply it out, you get $140,000. We have a Sprint, 5,000 units. Well, the market price is $6,000. and the cost is 5. We've been carrying it at 5 all the time. So that's good. We don't have an adjustment there. We just have an adjustment of $30,000. That's these 20 units up here divided by the difference. So here you have a new inventory value of 190. It was 220. The difference is $30,000 and requires an entry to debit cost of goods sold dash lower of cost or market, we used to call it, credit merchandise inventory, lower of cost or market. It's a method of recognizing losses as soon as they become apparent and not gains. Not the gains. Analyze the effects of inventory errors on current and future balance sheets. This I think you'll find interesting. Did you know if you make an inventory mistake in year 1, you have botched up year 2 as well? If you undercount the inventory this year, you have understated your profit. You failed to count an asset that's out there. That showed up as a loss in terms of higher cost of goods sold and thus a lower net income. But it also fouls up the next year unavoidably because you have to start the next year or the next month with that bad inventory number you took. So let's take a look at this now. Here we took an ending inventory of 16,000. And the correct amount, if you can read that, the correct amount is 20,000 here. It should have been 16. It should have been 20. We counted 16. So look what happens here. We now have come up with a gross profit of 36,000. Because we failed to count $4,000 worth, we have understated our profit for this month, okay? We were supposed to count 20,000. We only counted 16. So we have understated the profit, the ending inventory, thus overstated the cost of goods sold, understated net income. So look what happens in the next year. The next year, we start with the bad $16,000. And then we get to the next level here. We have purchases of 60, etc. And we come down to 64. Now we're showing $34,000 net income. We should have shown 30 and 30. Numbers were set up for us to come up with it with the right income, the same income each year or each month, 30 and 30. So as you can see here, because we failed to count something, we understated the inventory, overstated the cost of goods sold, which reduced our net income unfairly, okay? Now we have a $4,000 mistake reflected in 16 and 17 in the opposite way. The next year, when we count the inventory, this time we counted it correctly. So if you make a mistake in January counting inventory, it's going to foul you up automatically for the next month because you're starting the next month with a bad ending inventory from the prior month, okay? Failing to count inventory reduces your profit. Just try to remember that. If you overcount the inventory, well, that's probably worse. Now you're showing results that indicate you're doing better than you really are. That's a $4,000 mistake here. This is a big company. That's actually $4 million. That could be a big, big mistake, huh? And the company may look at this net income, which is lower by quite a lot than it should have been, and make bad decisions. They may say, gee, we're not doing as well. We need to lay off some people or cut off the second shift or something. And then you really get yourself in trouble. Inventory is normally your biggest asset and really needs to be controlled carefully. Duh, pretty obvious, huh? Financial statement effects of inventory on the balance sheet. If you understate the inventory, you're understating the assets and equity. And the opposite with the overstate. You'll overstate assets and equity. And any mistake in the first number, if you overstate in the first year, you automatically understate in the next year. And that can be a real problem. Where I worked for a long time with a company in downtown Los Angeles, we had a lot of intercompany accounting, and there were some mistakes made in getting the charges back and forth properly. And the bosses flew everybody in from around the country to yell at us and get things back on track. With intercompany accounting, we not only fouled up the total net income of the company, but also the individual companies who got bonuses based on their profits and losses. Fortunately, I worked for a small division, and we didn't have that much in intercompany accounting. It was not a hard job to keep track of, but I felt bad for some of the big boys at the bigger locations. Assess inventory management using inventory turnover and days in inventory, huh? Here you go. Here's a metric. Could it be on the test? Got to understand it. Inventory turnover. It shows how many times a company turns over its inventory during a period, and it's an indicator of how well management is controlling the amount of the inventory available, okay? Inventory turnover. It simply means, in clearer words, I hope, it's how many times you sold the average inventory. If you come out with 7 as the turnover, you turn the inventory over 7 times, meaning you sold the average amount of that inventory 7 times. What's the formula? Cost of goods sold divided by the average inventory, huh? Cost of goods sold divided by the average inventory equals your inventory turnover. Average inventory means the beginning and ending inventory divided by 2, okay? Days sales in inventory, better known as days in inventory. This reveals how much inventory is available in terms of the number of days sales, okay? So we're going to take the ending inventory divided by the cost of goods sold and multiply by 365. Oh, for heaven's sake, that's doing it the hard way. Okay, let's follow up here. The days in inventory, could you write this down? Because this is a much easier formula, okay? The days in inventory is 365 divided by the turnover. 365 divided by the turnover gives you the days. The days, okay? I'm surprised they don't give us an example here, but let's talk about it, okay? So our days sales and inventory, we've decided, is the 365 divided by the turnover. Now, suppose our turnover was 10. That might be or might not be good depending on the inventory, depending on the company, rather. Also, when you talk in terms of a turnover, upper management may not even know what you're talking about. They're not necessarily accounting people. You know, your president and chief operating officer could come from the science part of the business, could be an engineering background, a sales background. My point being, if you tell them that the turnover was, say, 7.2, that's not going to cut no ice. You're not going to know what you're talking about. But by taking 365 and dividing it by the turnover, that would give you days. So, for example, if your turnover was 10 into 365 is 36.5. That means it takes that long for you to get your product sold. That's how long it takes to sell your product, an average of 36 days. That's understandable even by management, okay? Merchandisers, planning control, inventory purchases. Costco and Walmart turnover and days sale. Let's take a look at this. Costco had cost of goods sold around 100 to 111,000. Their inventory levels rose quite a bit. Wow, went up maybe 12%, huh? Their turnover was 11.9. 11.9. The days in inventory were 32. So Costco takes them 32 days from the time they purchase their product to getting it out to a customer. That is super fast in any business I've ever seen. 32, 31.8, 32. Walmart doesn't turn their inventory over nearly as well. They've been stuck 8.1, 8.1, 8.3. It takes them 43 to 45 days to sell their product, to get it out the door through the customer, okay? 365 divided by the turnover. Appendix A. As you know, I'm not going into the appendix. I'm still waiting for Cornelia to give me a ruling on that. If she says that I was neglectful, I'm going to go back and go through them all in good fettle with you guys. But I don't believe we're going to go through some of these more obscure things. So with that in mind, that is the end of our lecture. Anybody have any questions or comments? How you doing, Isaac? Where's Isaac? Are you there, Brendan?
What's up?
Yeah, I'm just checking in. Any questions? Any comments?
I think I'm good for now. Just checking, what times are you doing tutoring this week? Just to review for the
Yeah,
midterm.
tutoring today at I'm going into class at 5. I'm on campus at 3 today, if that helps.
All right, I'm at school in Davis, so I need what was your virtual tutoring? Do you have any of those this week or
Yeah,
before Wednesday?
Thursday 5 to 7,
Okay.
and Sunday 5 to 7.
All right.
All right,
Sweet.
look forward to seeing you there.
Sweet. Thank you. Have a good
Maria,
day.
you okay, Maria?
Yeah, I'm good. I don't have any questions.
Okay, you make a motion to end the meeting? I'll assume Maria made a motion. How you doing, Isaac?
Good. How are you, Bob?
Good to have you back. I guess we'll see you around, huh?
Yep.
You take care, man.
You too. Have a good one.